The port of Corpus Christi was quiet. No tankers lining up, no engines humming, no deals coming through. As of mid-2025, U.S. oil shipments to China had vanished, dropped from 160,000 barrels a day to near zero. No embargo, no press release, just a 10% tariff, and the sound of America's largest export bet being ghosted. At the exact moment Trump was declaring energy dominance a done deal, China stopped answering the phone. U.S. ports built to supply the world's biggest buyer now sit half-used, feeding no one. Pipelines that once roared now trickle. Storage tanks bulge not from oversupply, but from disinterest. In Washington, Trump was still tweeting about wind turbines killing birds, while Beijing was quietly reprogramming the future of global oil, and not in dollars. The silence wasn't accidental, it was strategic. By April 2025, China had locked in multi-year supply contracts with Russia, Iran, the UAE, and Saudi Arabia. According to Bloomberg, most were denominated in yuan. Not a single deal routed through the U.S. banking system. This wasn't diversification. It was extraction. China removing American oil from its bloodstream entirely. And the irony, America helped build the export infrastructure that now sits idle. Between 2015 and 2023, U.S. Gulf Coast ports received over $25 billion in upgrades, new terminals, expanded docks, deepened harbors, all calibrated for high-volume shipments to Asia, specifically China. The logic was clear. Secure a dominant stake in the world's fastest-growing oil market. But by 2025, the bet had collapsed. Chinese refiners didn't wait for policy clarity. They stopped booking U.S. cargo altogether. Even with price cuts, Reuters confirmed in May that discounted U.S. barrels were still passed over. Not for lack of supply, but because China had already rewired its import system, refineries optimized for Russian and Middle Eastern blends, payment networks structured around yuan, and shipping routes anchored to suppliers outside Washington's control. And what did the White House do? According to the Wall Street Journal, it doubled down, blaming Canada for lumber prices and threatening tariffs on Mexico, all while ignoring the vanishing oil trade that once justified America's most ambitious export expansions. Let's pause here because this wasn't sabotage. It was surrender disguised as strategy. While Trump claimed victory over OPEC, China was redrawing the map. Quietly, permanently, India soon followed. In July, New Delhi inked expanded contracts with Rosneft and Saudi Aramco, backed by yuan-denominated settlements. Thailand, Malaysia, and Indonesia adjusted purchasing mechanisms to favor non-dollar invoicing. Even Vietnam, a U.S. ally on paper, began reviewing long-term supplier terms to mirror China's structure. None of this involved tanks or treaties, just paperwork, just contracts. The battlefield was Excel sheets, not battlefields. Meanwhile, U.S. exporters scrambled. Gulf Coast tank farms reported sub-60% utilization by June. Corpus Christi's oil terminal, which was built to handle 3 million barrels per day, saw outbound flow dip below 1 million. That's not a fluctuation. That's abandonment. And yet, in the administration's response was to claim this proved America didn't need China anyway. The contradiction. The entire U.S. export strategy was built around China. When Trump reversed his own tariff policy on aluminum, it was an admission not of flexibility, but of lost leverage. According to Financial Times reporting, Canada and Mexico now move over $120 billion in annual trade to their own Atlantic-Pacific corridors, bypassing U.S. territory entirely. Why? Because consistency matters more than slogans. And Washington's version of leverage had become code for volatility. But oil isn't just product. It's power, and power flows through currency. By mid-2005, Bloomberg reported that over 80% of China's oil imports were no longer settled in dollars. That matters because every dollar excluded is one less unit flowing through U.S. financial plumbing. And without that flow, the ability to monitor, restrict, or sanction weakens. Iran noticed. By the second quarter of 2025, Chinese purchases of Iranian crude had surged to 1.7 million barrels per day, 10 times what the U.S. had ever shipped to China. Much of it moved through the shadow fleet, a loose network of tankers operating under falsified flags, shell companies, and gray market paperwork. It wasn't just evading sanctions. It was erasing them. Wall Street Journal analysis showed that even with tighter sanctions on Iranian shipping in early 2025, enforcement mechanisms failed to track at least 40% of those exports. China's teapots, its small, nimble private refiners, snapped up the crude without blinking. It was cheaper, easier, and most importantly, not American. What once gave U.S. oil a competitive edge Its pricing, scale, and freedom molecule branding had been overtaken by something stronger: reliability, payment convenience, and geopolitics. And if the administration thought Iran was the exception, they weren't watching Saudi Arabia. Riyadh state oil giant Aramco had not only agreed to yuan-based settlements for select Chinese buyers, it invested billions into Chinese refining capacity. Co-owned infrastructure means locked-in customers. Locked-in customers mean long-term predictability, exactly the opposite of what the U.S. was offering. According to Financial Times, China's strategic petroleum reserves surpassed the 3-month import threshold in July 2025, meeting and exceeding IEA recommendations. Its suppliers? Russia, Iran, the UAE, and Saudi Arabia. None required dollar payments. None bore Washington's fingerprints. And this wasn't just about economics. It was about immunity. By building an oil architecture independent of U.S. financial systems, China created a firewall against American pressure. No SWIFT, no sanctions, no access required. The contradiction? America spent 2 decades warning about energy security, then weaponized its own system until buyers opted out entirely. And while the administration performed rhetorical victory laps about winning the trade war, the dollar's central role in global oil settlement began to quietly erode. By the third quarter, India had joined the shift. Deals with Russia and Iran routed through rupee-yuan swaps allowed payments to bypass Western banks entirely. Even European refiners, still buying U.S. crude, began negotiating extended payment timelines and non-dollar options to hedge currency risk. These aren't policy shifts. They're structural exits. The U.S. didn't just lose China as a buyer. It lost oil's last monopoly, the power to price, punish, and persuade through currency. And it wasn't forced. It was outcompete. Even Canada, America's oldest ally in the oil patch, quietly rerouted exports toward Asia. A July 2025 Reuters report confirmed Canadian crude shipments through U.S. ports had dropped by 40% year over year. The reason? Trade unpredictability and tariffs imposed during Washington's attempt to renegotiate everything at once. So, where does this leave America? Ports half built for buyers who've left. Pipelines to nowhere. Payment systems no one uses. A strategy that assumed price would always beat politics, and lost. The Financial Times reports U.S. exporters are now chasing secondary markets in Europe, South America, and Southeast Asia. But none match China in volume, influence, or pricing stability. You can replace a customer. You can't replace a market. And by August, that market had moved on. What's left? Noise, political decorations, legacy infrastructure, and a president still blaming wind turbines for cancer, while the world signs energy deals that no longer include us. Here's the irony. The U.S. helped create the rules of global energy trade. Now it's rejecting them and being ignored in return. No one banned American oil. They just stopped needing it. This isn't isolationism. It's irrelevance. And irrelevance doesn't announce itself. It creeps in, one unrenewed contract at a time, one redirected tanker, one yuan-settled barrel, one unreturned phone call. The reshuffling of global oil wasn't about confrontation. It was about calculation. And Washington, for all its bluster, was in the room when those calculations were made. In August 2025, data from China's General Administration of Customs revealed a staggering milestone. Not a single U.S. oil tanker cleared Chinese customs that month. 0 barrels, 0 processing, 0 delay. This wasn't a glitch. It was confirmation. According to S&P Global, even backup orders from independent refiners had dried up. U.S. oil wasn't just unwelcome, it was unworkable. Meanwhile, China's state-run Bank of Communications rolled out a new international settlement protocol, allowing direct yuan payments between energy suppliers and Chinese importers, bypassing both SWIFT and the U.S. dollar. The Financial Times confirmed pilot programs were already underway between Chinese banks and counterparts in the UAE and Iran. These aren't tests. They're alternatives taking root. In an even deeper shift, Saudi Aramco signed a joint venture in July to build yuan-clearing infrastructure inside the Shanghai Free Trade Zone. Not oil terminals, clearing houses. China isn't just buying oil. It's institutionalizing the currency that pays for it. This isn't a currency war. It's a currency transfer, one transaction at a time, one partnership at a time. And yet Washington is still threatening sanctions for a game that fewer and fewer countries are even playing. The market didn't move away from America. It evolved without it. So the question now isn't, how do we lose China? It's, what happens when the rest of the world realizes they don't need us either? Because when the world stops calling, it's not a negotiation tactic. It's the new normal.